Hey, have you ever wondered what a VC looks at before investing in a company? Today, you'll get first hand knowledge from someone who's worked with a lot of VCs, and I'm going to be guiding you today in terms of what it takes to create a VC investable startup and what do VCs look at before investing in a company. So, there are essentially 11 major elements which the VCs look at. You might think that's a lot, but after all, if you're getting crores of rupees of investment from the VCs, obviously you need to be prepared, right? So, let me get into each and every one in more detail so I can explain you at length what they typically look at, and you can then prepare your startup accordingly. So the first thing which most VCs generally tend to look at is the team. Now, essentially, an early stage business is essentially all about the team because there is not much product there, there's not much revenues there, just a few crores of revenues here and there, and that is not much for a VC to decide. There's not much information for a VC to decide how to invest in the company, right? So that is why the first and foremost, the most important thing which the VC decides to invest in is the team. Who are the founders? What is the capability of the founders? What is their past experience? Do they have decades of experience in the industry or not? You see a lot of these early stage founders getting funded left, but at 25 years of age, 26 years of age, but that's more of an exception than a norm. Most of the investors typically have happen at a later stage when the founders have at least a decade of experience and they bring that experience and they bring that specialized field of knowledge that they have into the company that they're building, and that's what makes it successful. That's what a VC is generally looking for. What is that unique advantage that you can bring to the table as a founder which can make the company successful? That is the number one criteria, and essentially what they are thinking about is why you, because essentially VCs want to invest in startups which become category creators, right? Think about an example like an Uber or an Ola, or in the housing space, you look at housing.com. These guys became category creators. In restaurant space, we have Zomato, and you have Swiggy. These two are essentially the two category leaders, right? These are the kind of companies which the investors are looking for, which essentially become category creators. So the bar of reaching that level is extremely high. That is why it becomes extremely important that you can ask yourself that question realistically. Why should the VC invest in you? What makes you so special that the VC should invest in you? What is your unique special advantage which no other founder in the industry has to solving this particular problem? And once you answer that question, then you'll have the answer to how to getting the VCs to invest in you. That's going to be the most important thing. They in the founding team, they also look for complementary skills. So you'll have one founder who will be on the technical side, who will be building the product, who will be architecting the entire details and the specifications in the product, doing on the ground market research to understand what the people actually require. This is going to be a product or a tech person who's going to be creating all of these elements over there. Then you will have a developer who will kind of build the product out right from the front end to the back end, etc. Then you'll have a business person who's going to be constantly reaching out to more people on the ground, trying to sell the product, trying to pitch the product, because unless you sell and pitch the product, you don't have a company. uh, Startup product is not just create a product and hope that it sells. You need to eventually sell it, and you need to have a business person on the team who's actually going to go out and sell the product in the market. So this is these are the bare minimum essentials for a founding team. Going forward, you need an operator as well, but to begin with, the founding team needs to have these at least two three people who take care of the core responsibilities of the business, that is building the product and selling the product. So this is just on the team part of it. So next area which the investors, the VCs look at for investing in a company is the TAM SAM song. I'm sure you must have heard that a lot during your experience working with a lot of VCs and investors, right? So what does that exactly mean? TAM means the total addressable market. SAM means the serviceable addressable market, and SOM means the serviceable obtainable market. So TAM is the total universe of the entire business market opportunity which is there. Now the problem is most of the founders, they completely mistake these metrics and they give false information or misleading information, or probably they themselves are not sure of what the accurate number is, and they communicate these numbers to the VCs, which is a huge put down for most of the VCs there and there itself. So to kind of give you an example, if we have a garage company, right? A garage company would claim that their TAM is the entire automobile market, but that does not really make sense, right? The entire automobile market is not the TAM. The TAM is the garage market. how many people actually go to garage, and what's the garage revenue across the world or across India for that matter. That is the actual TAM. So getting that distinction is extremely important. Likewise, if you are in, say, fintech industry and you're specifically operating in the payment space, so you cannot say the entire financial sector or the entire fintech sector is your TAM. You need to be specific about what exactly product you're selling and identify your exact TAM, and identify what range what's the actual value of that, because that is the actual TAM. Getting that right itself is going to be a huge boon for you in terms of communicating that you've done your ground research very well and you understand the market very well. That communicates a lot of maturity to the VCs. So that's the TAM part. The SAM part is a lot of the times you have a lot of limitations in terms of product, right? You can't practically sell to each and every person in the market. There are certain things where you need to prioritize in terms of which product features you should want to focus on. So SAM takes care of that. So in the total addressable market, there'll be specific areas which you can cater to, the specific problem points that you cannot cater to. So the ones which you can cater to, that will come in the SAM part of it. The problem statements which you can actually solve considering the product constraints. That's your SAM. So getting that understanding will give you more idea regarding what realistically a market is like. And SOM is considering the limitations in distribution, right? As a founder, if you say the entire universe is your market, right? That is the biggest red flag for any investor, because if you try with your limited resources, you need to be very specific and very focused on the market that you want to reach out to attract customers. You cannot reach out to hundreds of thousands of customers or millions of customers, with the hope of acquiring customers. You need to be very specific, very targeted, very proficient in terms of identifying that, right? That these are my target customers which I want to reach and create my strategic advantage. So getting that SOM clear is extremely vital. In fact, Peter Thiel used to have a very popular saying, right? That you need to create monopoly when you want to compete in a marketplace, and competition is for losers. So the idea is, how can you create a micro monopoly in the area which you're doing, in the area which you're operating. So thinking along those lines in terms of identifying that narrow niche for yourself and creating a small monopoly for yourself in that niche, that goes a long way in terms of getting your early traction and identifying the swarm of your market. Through that, you can then later expand into other areas and then expand once you get bigger. But getting this sorted in the beginning stages is extremely vital. The next important element which the VCs look for is the business model. Now, this is going to be absolutely vital for most businesses, most startups, most VCs, right? Unless you have a solid business model in place, you have a solid way to capture revenue, uh, you don't have a business, right? I see a lot of times they are still coming up with social media apps. To be honest, at this day and age, with so many social media apps already there, the demand for social media apps really isn't much there in the VC circles, unless there's something really groundbreaking. And even if that is there, you need to have a commercialized element to it. Without a commercialized element, it becomes extremely difficult. So you need to have a clear criteria, a clear understanding of what the business model is going to look like. Whether it is going to be subscription, it's going to be one time, what's going to be the lifetime value of it, what's going to be the CAC for it, and most importantly, what's the LTV to CAC ratio, because that's going to give you the idea of whether you're making money or not making money as you kind of grow, right? LTV to CAC ratio is considered the golden ratio in terms of ensuring that your business is operationally making sense, that you're gross profitable, and that you're not ending up losing money while growing your business. So that is extremely vital. This is the business model element of it, essentially how you make money. So as a startup, your job is to not only create value but also capture value. That's captured in the business model, and you need to have a sound business model in place which makes sense for your industry. Now, how you come about coming up to a right business model, there's no uniform answer to it. It's different for each and every industry. So you need to really think through about it. What makes sense for your industry, and apply that to it. Ensure that you have a proper business model in place for that. So the next element which most VCs look for is the product. Now, essentially, eventually, as a startup, you're selling a product, right? So getting the product in place is without a doubt the most important thing in terms of actually start making money. So what does the product look like? What features does it currently have? Are the features actually solving an immediate pain point in the market, and are the customers willing to pay for it? Is it a very deep tech, a very complicated tech? What is your unique IP about it? That is extremely vital in terms of ensuring that the product is ready for the market. One more very important thing is this the right time for your product in the market, right? A lot of the times what happens is your product is just too early in the market, where the market is not ready for a product like that. And because of that, what happens is, the doesn't matter how aggressively you push the product, people will not be receptive to it. So that is why getting the timing right for the product is also extremely vital. If you are too early, the market will not respond to it. If you are too late, the market is already adapted to it and they no longer care. There's no differentiation anymore. So that is why getting the timing right is extremely vital as well. So next, and one of the most important elements again is the revenues or the traction, right? A lot of the times, a lot of the I receive a lot of pitch decks startups sent to me for evaluating their startups for investment, etc., etc., and they have no revenue slide, they have no traction slide, and that is a big mistake, big red flag, because that clearly communicates to me that you don't have enough revenues for your company yet, and that's why you're not sharing it to me. Because if you had, you would have kind of showed it off, right? If you made like a 5-10 cr of revenues, you would show that off right in the beginning, or maybe somewhere in the middle, to kind of show off that we've already achieved this success and now we need your help to go to the next level. But if you don't do that, and if there is no revenue slide, it clearly communicates the fact that you haven't achieved much revenues. An exception to that is obviously if you're a much more advanced Series C, Series D company, and that's a different story. But that's not the case for most of the companies, right? For most of the companies, they don't have the revenues, and that's why they're shy of it, and that becomes a huge problem. Getting without in today's day and age, if you're not a very advanced deep tech startup, or a med tech, or a complicated hardware tech startup, you need to have revenues before you go to investors for investment, because without those revenues you literally have no value prop. It communicates that you haven't bothered to kind of go to the market and try to sell the product. You don't have that market feedback in terms of, is the market willing to pay for your solution or not. So revenues is absolutely vital before you go for a VC for investment. Now, whether it's a micro VC or a proper VC, it doesn't matter. Every VC today requires some form of revenue, some form of traction before they consider you for investment. So getting that right is absolutely vital. Next come the financials. So financials, in terms of not just the revenues, but also in terms of ensuring that is the financial jurisprudence being maintained or not. So now you might have revenues, but you're spending money like crazy. And operationally, if you look at it, if you end up spending 1,000 rupees for making 100, 200, 300 rupees of revenue, right? That's a huge red flag for any VC in terms of investment, right? So that's why getting the financials in order is absolutely vital. The general golden rule of thumb is that you need to ensure that you are at least gross profitable when you're selling your product and service, right? You're not expected to be net profitable, which is pretty much unheard of at such an early stage, but you're at least expected to be gross profitable, where you make more money than the cost of goods sold. As long as that is there, you don't really need to worry much about it. But getting that financial sorted is absolutely vital. So this involves a lot of things, like what is the customer acquisition cost, um, how much money that you have, excuse me, how much money that you have in the bank, how much runway that you have, what's your current burn rate. These are some of the major elements which a lot of VCs require in terms of ensuring that your your business is sound and you have a few months of runway before you can start investing. Ideally, the best time to raise money is when you don't need money, because that way you have the time to negotiate with the VC, you have the time to leverage with them, and attract generous offers from them. If you're desperate, they know that you're desperate, and they can then squeeze you on the terms of the deal, on the valuation, etc. So that's why you need to have sound financial systems and financial jurisprudence in place when you're looking to raise capital. One more very important thing is the competitive advantage, right? What is your unique competitive advantage? We already discussed this earlier in terms of in the founding part of it. That as a founder, why you should be the best team. So you need to be kind of more detailed, more elaborate about that. That what is your specific competitive advantage in terms of solving this particular problem, right? Why should they invest in you? Why should they invest in your company? Why should they invest in the other founders? Why is now the best time to invest, right? These are some of the questions which you need to answer to the investors, so that they communicate the fact that your startup is really interesting for them to get invested in. So this competitive advantage goes a long way. One more important thing which most founders tend to miss out at is the exit potential. So when you're looking to raise money for your business, right? The investors, when an investor is investing money in your business, the investor is essentially looking for an exit, right? Um, Essentially, an investment. It's not a charity case. It's not like you simply put money and hope that the startup returns money or return capital, whether or not it happens or not. It needs to be something very serious, and it needs to be something very focused, and the founder needs to be prepared for that. that if the investor is putting money, his trust in you, you need to be in a position to return that money to the investor, and you need to have a proper exit potential in mind, that exit plan in mind for the investor, to ensure that they get the capital back within say the next 2 years, 3 years, 5 years. Because if that is not there, then the investor will think the founder does not care about my money. Why should I care about the founder itself? So getting that thing sorted in the beginning is extremely vital as well. What are the potential risks that you might face, right? Now, every business, every startup, they have risks in terms of market risks, environmental risks, competitor risks, and all the other risks, right? You need to be very upfront and transparent about that and kind of communicate that to the VC, because pretty much they more or less would have that information already, but they would want to know that you know the same as well. Because if you know the same as well, it shows a heightened level of awareness that you've done your ground research and you're on your game. Now, there is no such thing as a risk-free investment. Every VC is prepared to take the risk, because every investment has a risk and every VC knows that. But what is important is the VC needs to trust in your ability to identify the risk, that you are aware of the risk and that you can mitigate that risk. That is extremely vital. That's what you need to communicate. If you say that there is no risk in my business, there's no competitive risk in my business, that just shows the naivety of the founder, and that's a huge red flag for a VC, because every VC understands this. There will always be risk, especially at early stages. So you need to be very detailed and very thorough, and understanding about what the risks are for your business, what the potential pitfalls could be, so you can then accordingly communicate to the VC during a session. So one more very important thing, which is not pertaining to your company, but it's more related to the VC, right? That whether the investment opportunity fits his portfolio or not. Now the question becomes that when you approach a VC, right? If you randomly approach random VCs, whether they have a sector focus or not, right? That is itself a huge put down for most of the VCs. So it's extremely important that you do some past research on the VC. What kind of companies that they've invested in the past. Does it fit with the kind of criteria that they're looking for? Does it fit in their portfolio services? Can there be potential synergies with the existing portfolio or not? Those kind of synergies play a long way in terms of ensuring that that your startup is the right fit for the VC and his portfolio, and it makes his portfolio look good. So the category fitment and appearance fitment is extremely vital in terms of ensuring that your startup eventually gets funded by the VC. And most important in the end is the founder investor fit. So after all these 10 points, the 11th point which comes is the founder investor fit. Now, a lot of times you think that VC just puts money and kind of goes away and let me do my thing, but that is the most naive way of looking at it. Essentially, the investor is looking for a founder who's extremely coachable, who's flexible, who's willing to learn and understand and adapt and grow from it. Right. At the same time, he also looking for a founder who's taking care of. So, the investor business model is to give return to the investors who invested in the VC's fund. Right. So, for the VC, they need to work with founders who understand this, that essentially it's the VC's job to return capital to the investors who've invested in the fund, and they need to work with founders who understand that. And when founders don't understand that, you have scenes like currently happening with Baiju and other companies, where essentially the founders completely gone um, AWOL, or completely kind of taking the company in the wrong direction with the current situation. So that's why it's extremely important to ensure that there's a good founder investor fit, and that is something which the investors are extremely choosy about, to ensure that this is the founder that they like to work with, and this is a founder who actually cares about their returns and ensures that they give a good return to the investors. So having that synergy is going to be extremely vital as well. So these are the 11 major areas which you need to look at in terms of ensuring that a VC would look at your company for investment, and they look at it solidly and they make it consideration, right? You might think it's a long a long list to kind of take care of, but essentially if you are asking someone to invest 10, 20, 30 cr in your business, you need to do this kind of hard work, right? Raising capital is not easy. If you think appearing for IIT JEE exams or UPSC or civil services exam was tough, raising VC money is even tougher, because it is an extremely competitive business. It is extremely hard. Very it has a lot of hard work, and essentially you need to be a category leader in the space for a VC to think about investing in you. So having these basics sorted is absolutely vital to ensure that the VC invests in you. And once these criteria are met, that skyrockets your chance of getting a VC investment. So I hope this video was helpful for you. And if you like this video and you want to ensure that you keep learning more about how to grow your business, subscribe to my channel, click the bell notification so to ensure that you don't miss any further videos, and you can keep learning more from this and in, implement these principles in growing your business. So hope you had a good day. Take care.